Good afternoon and welcome to this Kingsley Napley webinar on anti-money laundering for estate agents, what you need to know. So my name is Colette Best. I'm joined by my colleague, Ian Kho. So Ian is a senior associate in our regulatory team, and he actually specialises in defending firms and senior individuals in facing investigations by their regulator in respect of anti-money laundering issues. He focuses particularly on the accountancy and financial services sector, but he also regularly advises firms and professionals who are being investigated by the RICS. And my name is Colette Best. I'm Director of Anti-Money Laundering in the regulatory team, specialist in anti-money laundering. So my background is that I used to work at RICS back in 2006, 2007, wrote the guidance on anti-money laundering for estate agents when the 2007 regs came in. I've done lots of anti-money laundering stuff subsequently. And my last role was as Director of Anti-Money Laundering for the Solicitors Regulation Authority. But in my current role here at Kingsley Napley, I provide advice, services, audits and defence to property professionals and lawyers. So if we just move on to the next slide, what we're hoping to give you today is quite a broad overview about the money laundering regulations. We'll probably speak for around half an hour or so. We've got 15 minutes for questions, so we should have you out of here by sort of 1:45-ish. If you'd like to ask a question, we do have time for question. Be really happy to receive questions live, so you can pop a question in the Q&A box below. Be lovely to have your name and read out your name, but if you want to ask it anonymously, then absolutely do so. So as the slide says, we're going to be covering off the main things that you need to know as part of the anti-money laundering regulations, but in particular, the policies, procedures, controls, and structures that you need to have in place to make sure that you are compliant. So why don't we start by talking about supervision and registration on the next slide. So you will almost certainly be aware that if you are offering estate agency services, you must be supervised by HMRC for anti-money laundering purposes. So the Money Laundering Regulations use the 1979 Estate Agents Act definition of estate agency. So essentially, if you're effecting sales in real estate for customers in England and Wales, the chances are you're in scope of the money laundering regulations and you need to be supervised. Letting agents are also partially in scope, so that is typically at the higher end of lettings, where you're collecting rent equivalent to €10,000 or more per month. But we're probably not going to go too much into the letting agent side today. We're going to be focusing on the estate agent side. So as I say, if you fall within those definitions, the first thing that you must do and hopefully have done is register for supervision with HMRC. They also run an annual renewal process, and those renewal emails will come to the person whose details you first registered with HMRC. It can be quite easy to miss an email from HMRC about renewing your registration and find yourself dropping out of registration, which is sort of then quite a lengthy and a bit of a nightmare process to get yourself re-supervised. So do make sure that you are checking your inbox and replying to HMRC when they contact you. So other things that you need to do in terms of registration, so you need to register your BOOMs, that's your beneficial owners, officers and managers. And as the names imply, these are the senior people in your business who have got responsibility for AML supervision and compliance. And the chances are these do change from time to time, so it's worth just checking who you've registered and just making sure that you're keeping those people up to date. It is a criminal offence to be a beneficial owner, officer or manager and not be registered individually with HMRC. So HMRC also have a senior management program, which means that they hold senior managers responsible for compliance with the money laundering regulations. So if you are one of those senior managers in an estate agency business, you need to be sure that you are identifying, assessing, and managing the risks that your business has of being exploited by criminals to launder money. You must then take a risk-based approach to managing those risks in a way that focuses the effort more on high-risk areas. We're going to be talking a lot about the risk-based approach today. That's something that sort of is enshrined in money laundering regulations and really flows through all of the requirements. So the fact that you must know which services, products, areas are the most likely to be used to launder money, and that you should focus your resource and effort on those areas. So just carrying on with things that you must do if you're a senior manager, you must appoint a nominated officer to report suspicious activity to the NCA. This is often referred to as the money laundering reporting officer. And just a top tip, if you are a money laundering reporting officer, make sure that you've registered for the NCA suspicious activity reporting SARS online system. So the last thing that you want to be doing in the event that you are trying to report suspicious activity is having to go through that registration process at that point. And then finally, you must devote enough resources to address the risk of money laundering, terrorist financing, and proliferation financing. I think probably the final thing just to mention on registration and supervision is that HMRC has quite helpful guidance for estate agents. Hopefully you've downloaded that. It's not very long, certainly not compared to the legal sector guidance, which runs to kind of well over 220 pages. It is quite a helpful guide, so it is well worth reading it and downloading it. So what I'll do now is I'll hand over to Ian to talk a bit about how to do a firm-wide risk assessment.
All right, thanks, Colette. So in terms of firm-wide risk assessments, conducting a firm-wide risk assessment is a legal requirement under Regulation 18. And essentially doing a firm-wide risk assessment requires you to identify and then to assess the money laundering and terrorist financing risks that are specific to your business. So essentially, you're stepping back a bit and then thinking carefully about the risks that are specific to your client base, the types of properties that you deal with, the geographies that you might be involved in, the types of transactions that you undertake. So for example, if you deal a lot with complex ownership structures or unusual funding or third-party payments, then obviously those will be slightly higher risk. And then also considering the delivery channels that you might use. So if you use, for example, online platforms to onboard clients, or you have a lot of overseas referrals, then again, that might be something that is slightly higher risk that you should also consider as part of this assessment in the firm-wide risk assessment. There's a couple of things to remember when you're conducting that firm-wide risk assessment. The first is that it needs to be fairly comprehensive and tailored to your specific firm. So doing a copy and paste exercise where you use a generic template isn't going to be enough to satisfy HMRC. It also needs to be proportionate. So if your risk profile as a large commercial agent dealing with international clients, that might be slightly different to the risk profile of a, for example, sole trader with a local residential portfolio. It also needs to be documented, so it can be digital, but it needs to be recorded in writing somewhere, and then that will make it a bit easier when you're communicating it to staff later on as well. And then the final point in relation to tips to remember when you're conducting the firm-wide risk assessment is that it's really important to review them at regular intervals. So it should be ideally a living document. And the HMRC guidance says that it needs to be reviewed at least on an annual basis, but you might also want to update your firm-wide risk assessment if there's some sort of material change to your business. If you start dealing with overseas buyers or you expand into a new property type, then it's worth having another look at whether you need to update your firm-wide risk assessment. So the bottom line for your firm-wide risk assessment is it's a real key cornerstone, it's a real key document for your firm, because it should help you to understand the specific risks that your business faces, and then how those risks might change over time, and then what it is that you can do to mitigate those risks. And then once you've had a careful think when you're doing your firm-wide risk assessment, that should later on inform your policies and procedures, which is the more operational aspect. And that's something that Colette's going to talk about now.
Thanks, Ian. So yeah, let's move on to policies, procedures and controls. So as Ian has said, the firm-wide risk assessment is really the backbone of your AML controls. So you've decided through your firm-wide risk assessment where your high risk areas are. So what you then need to have set out in writing is your policies, procedures and controls to mitigate that risk. And I think this really serves two purposes. One is it's your office and staff manual so that everyone knows exactly what they've got to do in all circumstances. But it's also a really important document to not just be complying, but to be seen to be complying, so that you can demonstrate to your supervisor, if asked, perhaps as part of an inspection or desk-based review that HMRC does, exactly how you're complying with the money laundering regulations. So I've set out the main aspects of your policies, procedures and controls, and we're going to come on to talk a little bit more about them in more detail in a moment. But let me just briefly cover off sort of the high level points of what you need to have in your firm-wide risk assessment. So I think point number one is, as Ian said, make sure it's well documented and written down. The adage in compliance is if it's not written down, it doesn't exist. So it does need to be fully documented. And then first point is how to do client risk assessments. So what you'll need to do for each client is have a written assessment of risk, and your policies, procedures and controls will direct your team as to how exactly to do this and how exactly to document it. So that might mean that you've got a template that you use and that your policies, procedures and controls direct firms to understand what areas might constitute higher risk clients. So for example, if you've got a client who is selling a super prime property, your policies might be directing them to assess that as high risk. And then secondly, it's really important that your policies cover off the details of how to do customer due diligence. And Ian's going to give a bit of detail on this in a moment, but I think from a sort of a policy and documentation perspective, the important thing is to make sure that you're not just saying identify customer. Policies really do need to go into a lot more detail about exactly for different customer types, how exactly you'll go about doing that. So how will you identify an individual if they're selling a property? What if it's someone who doesn't have standard forms of identification? What if the property is held by a corporate or by a trust? So your policies really need to go into the details of that. And then next, they need to cover off enhanced due diligence. I'll be speaking about that in a moment, but really they need to cover off when it's required and how exactly to go about it. Then your policies need to cover off how staff are expected to do ongoing monitoring. So there are a couple of aspects of this. One would be customer due diligence document refresh. So that is, for example, if you've got a long-standing client, perhaps a client who you have sold or are selling a portfolio of properties for, if they've been on your books for over a year, over 2 years, over 3 years, then at some point you will want to refresh their customer due diligence, and most firms do refreshes on a 1, 2, 3 year for high, medium, and low risk clients. For many estate agents, that's probably not going to be as relevant. The more relevant aspect will be monitoring for any changes, anything that might, for example, change the risk pattern of your property. So, for example, if you discover that the property is being sold by a couple rather than an individual, that's absolutely something that you need to monitor and do additional due diligence for. Then finally, red flags and reporting suspicious activity. This is something that HMRC really likes to see set out in policies. So a list of things that might raise suspicion for money laundering. And the HMRC guidance is actually quite helpful in this area in that it sets out a number of red flags, which you might want to take a look at, see if they're relevant. And if they are, you might want to borrow those for your policies. And you also need to cover off what happens if you identify those red flags. So who do staff go to if they've formed a suspicion of money laundering? The contact details of your money laundering reporting officer, and then going through the process of what your money laundering reporting officer would need to do in that situation in terms of making a report to the National Crime Agency, keeping records, making sure that you're not undertaking any work while you're waiting for permission from the NCA, and making sure that you are keeping that information confidential. You're not telling a client that you've submitted a suspicious activity report and risking tipping off. And then finally, your documents, your policies need to set out how long records are to be kept for, and exactly how those are to be kept. But I think it's probably fair to say that the main bulk of your policies, procedures, and controls will be setting out the details of customer due diligence. So let me hand over to Ian to speak a little bit more about that now.
Yep. So as Colette said, it's really important to have good client due diligence processes, also called CDD. So basically having a really good understanding of who you're dealing with, the nature of the transaction, whether you need to be thinking about enhanced due diligence, and whether the overall risk profile means that you need to apply more scrutiny before taking it on. So I don't think we have time to do a deep dive. So I've split it up into 3 basic questions. Who, when, and how do you conduct client due diligence? The first is, who do you need to conduct client due diligence on? So CDD has to be conducted on all clients with whom you establish a business relationship. And a business relationship under the regulations just means when contact is established with a client, obviously that contact being relevant to the firm's business, and the relationship is expected to have an element of duration. So in the estate agency context, this is going to depend on the point of the transaction. So you'll typically need to conduct CDD on the vendor if you're acting for them in the sale, obviously, but you should also remember to treat the purchaser as a customer for CDD purposes at the point when the purchaser's offer is accepted by the seller. So this is something that's quite often overlooked by estate agents acting for the vendor, but the HMRC guidance is quite clear that both the vendor and the purchaser are to be treated as customers for CDD purposes once an offer has been accepted. And then in the case of clients which are companies, CDD goes beyond just verifying the company's registration details. You have to identify, as some of you may know, the beneficial owners of the company. So under the regulations, this means individuals who own or who control more than 25% of the shares or voting rights, or who might otherwise exercise some form of control. And you can do that by checking Companies House, and also having a careful think about whether the ownership structure of this prospective company client makes sense given the anticipated nature of the transaction and what they're asking you to do. The second point here is when do you conduct CDD? So the client's identity and, as we've said, any identity of beneficial owners need to be verified before you enter into a business relationship. But that obligation to conduct CDD also continues throughout the life of a business relationship. So you should continue to monitor that business relationship after it's been established. And that monitoring can be done on a risk-based approach, but you should really be keeping records of all the information that you collect for CDD purposes, and then also keep records of any updates that you do as part of that, ongoing monitoring process. And then the final point here is how do you conduct CDD? In terms of how you do it as a starting point, and as a lot of you might be aware, it's identifying and verifying the identity of the client or any beneficial owners. So for individuals, that might mean, you take copies of official photo ID, confirming their residential addresses with utility bills. For corporates, it might be, company registration details, the names of directors or senior managers, and looking at the ownership structure of the company to identify any ultimate beneficial owners, so UBOs. You'll then also need to verify and document source of wealth and the source of funds. And it's not just how they've built up their net worth, but also the origin of the exact sum of money being used in that specific transaction. And to do that, you can look at things like company accounts, you can look at recent bank statements, you can look at letters from solicitors, you can look at investment portfolio statements, but just getting a good idea of the source of wealth and the source of funds of that prospective client. Then once all of that is done, you need to step back and then assess the risk profile overall. So think about what you're being asked to do in terms of the services you're offering, and then what the expected nature of the transaction is, and then think about also the potential risk level of the client. So you'll be able to arrive at a final assessment of whether the client is low, medium, or high risk. If it's lower risk, you might be able to apply simplified due diligence in some cases, but if it's a high risk or if there are certain red flags that you come across, then you might need to do enhanced due diligence or apply additional scrutiny. And I'll hand back to Colette to talk about enhanced due diligence.
Thanks, Ian. Yeah, so if we move on to enhanced due diligence, and I'll also speak about politically exposed persons. So you must apply enhanced due diligence, also known as EDD, if there is a heightened risk of money laundering or in certain situations. So, as I said, the specific situations where you must apply enhanced due diligence is for politically exposed persons, or PEPs, as they're often referred to, or high-risk third countries. So let me just unpack those definitions a bit. So politically exposed persons is anyone who is entrusted with a prominent public function, either in the UK or abroad. It can be quite tricky because this definition also includes close known associates and family members of those politically exposed persons. And there's no list anywhere. So you might be familiar with sort of financial sanctions legislation where there are lists of people who are sanctioned. There isn't a sort of a governing list of people who are politically exposed persons. But essentially, they are people such as heads of state, ministers of government, members of governing bodies of political parties, members of Supreme Courts or constitutional courts, ambassadors and high-ranking officials, officers in their armed forces, and members of supervisory bodies of state-owned enterprises. So it is a reasonably broad definition, and as I say, that is extended by the fact that it also includes their family members and close known associates. High-risk third countries, the other situation where you must imply enhanced due diligence. Those are governed by the Financial Action Task Force. They have two lists, they're referred to as the grey list and the black list. And those are currently the high-risk third countries. So those do change fairly frequently. As it stands, we're just about to have a rejig of the high-risk third country list. FATF will be looking at that this week. So bear in mind that those list of countries do change quite often. So if your client is ordinarily resident in one of those high-risk third countries, so perhaps one who lives abroad but owns property in say, London, or if you're acting for a company that is domiciled in a high-risk third country, then you must be implying enhanced due diligence. Outside of those two factors, you need to be taking a judgment call around what is high risk. The factors that you've set out in your firm-wide risk assessment, in your policies, and in the HMRC guidance, those go into quite a lot of detail as to what would be considered high risk. So it's well worth making sure that you've read and had mind to those. So if you've identified that enhanced due diligence is appropriate, what it essentially means is that you must be doing more to mitigate that risk of money laundering. So that can be around verifying the identity of your client, or it can be around doing more about scrutinizing the transactions that you're being asked to do. And this is one of the things that, as I said, your policies must set out exactly how this goes beyond what you would do as part of your normal or standard due diligence. So that must be set out and documented. But some of the things that you might be doing is you're getting additional information or evidence around your client's identity. You might be taking additional steps to verify those documents. If you're receiving payments, you could make sure it's made through a bank account and name the person that you're dealing with. And you could be doing more regular and more stringent ongoing monitoring checks. And just going back to those two particular categories of enhanced due diligence. So if you've got a client who is a politically exposed person or from a high-risk third country, in those instances, you must be getting source of funds and source of wealth checks, and you must be getting senior management approval to go ahead with that transaction. So I think source of wealth checks is something that is quite tricky to do and to document, but it essentially means establishing and verifying through documents the entire body of that person's wealth. So essentially what these regs are designed to do is to prevent against corruption or embezzlement. So you must make sure that if you're dealing with a politically exposed person, that you have fully evidenced their full source of wealth. And I think one final thing just to mention is that at time of speaking, so that's mid-June 2026, high-risk third countries are classed as the FATF black and grey lists. We're about to see a change to the money laundering regulations that means that will be restricted just to the blacklist, albeit you might still be doing enhanced due diligence on grey listed countries because you view them as risky still. But as it stands, again, at the time of speaking, the three countries that are on the FATF blacklist are the Democratic People's Republic of Korea, Iran, and Myanmar. So those would be the three countries that going forwards, once those new regulations come into force, you would have to be doing those source of wealth checks for. So why don't I pass over to Ian to talk a little bit about how to train staff in this record keeping and audit.
So we're coming to the end now of this webinar, and there's just a few final things to cover off in terms of other obligations that you might have under the regulations. The first one is training, and the obligation here is that you must, ensure that your staff are regularly trained and they're aware of all the themes that we've covered today. So things like risks of money laundering in this particular sector, who the MLRO is, what their own obligations are, what are the firm's procedures in recognizing money laundering, and then how to deal with it. So those are the sorts of things that you should be thinking about training your staff on a fairly regular basis. And that can be, face-to-face training. It can be HMRC webinars, going to conferences, meetings, to look at issues and risks. But regardless of what format the training takes, you should definitely be keeping training records. So those records can be a copy of the training materials, who was a speaker or who provided the training, list of the staff who completed the training, because the usual concerns that we see here is either not enough training being given, so relevant staff only completing a one-off online module years ago, or training being potentially given on a fairly regular basis, but it actually not being recorded in writing. And so when HMRC comes in and asks for those records or does an audit, then it's fairly difficult to evidence that training has been done on an ongoing basis. The second point here is in relation to record keeping. So we've tried to labour the point throughout the webinar that record keeping is a really important requirement throughout the regulations. You should definitely be keeping copies of things like your client contracts, but also details of transactions, the supporting evidence that you use to satisfy your CDD processes, any risk assessments that you've done for each client. And here you need to remember that you need to keep records of CDD checks for a minimum of 5 years after the end of the business relationship with that client. And then obviously you should have written versions of all the key AML documents that we've talked about today. So your firm-wide risk assessment, your policies, controls and procedures, your training records, and all those sorts of key documents. And again, if HMRC comes knocking and they ask to see your AML documentation, then good record keeping will mean that you can clearly demonstrate that you've previously complied with the money laundering regulations and it is being complied with on an ongoing basis. And the final point we're going to cover today is independent audits. So Regulation 21 of the regulations requires an independent audit function to test and to evaluate how effective a firm's AML policies, controls, and procedures are. So whether this particular requirement applies to your firm will depend on the size and the structure of your business. So larger estate agency businesses, with more complex structures, you have multiple branches, you have significant transaction volumes, then those sorts of firms usually have an independent audit function in place. Whereas, smaller agencies might be exempt from this requirement. So if you are one of those larger companies, then you are required to have one. And there should be an independent audit of the quality and effectiveness of a lot of the matters that we've discussed today. So the audit should look at things like, are ID checks being conducted correctly for CDD purposes? Are higher risk customers being identified and, extra scrutiny being applied for EDD, as Colette's talked about? Are relevant employees all receiving, regular and up-to-date AML training? And if it's being conducted internally, then it should be independent. So it shouldn't be the same individual doing the audit who is also responsible for implementing the AML policies. And sometimes some firms find it useful to have an external expert come in and do a more arm's length review or an independent review of their whole AML ecosystem. And then they can, look at the things that the firm might be doing well, but then also point out certain things that might need improving. So the final point on this is, regardless of whether your firm requires an independent audit function, it's definitely best practice for firms to regularly test the AML framework. So you should, as a matter of fact, best practice, be doing annual compliance reviews of your AML policies and procedures, and not just looking at the documents themselves, but how they're being implemented on a firm-wide basis. Reviewing your firm-wide risk assessment if there are any material changes to your business, and then also maybe doing some, dip sampling of files to verify that CDD is actually being conducted and that firm processes are really being followed at the more coalface level of things. So I'll hand back to Colette to say a few words to conclude.
Super, thanks, Ian. We've got about 10 minutes left. We haven't had any questions sent through. If there's anything you do want to ask, just pop it in the chat. But we've had a couple of pre-submitted questions. So why don't we just whip through those sort of on a bit of a quick fire round. So I'll maybe ask one to Ian and then hand over to Ian. So one thing that I get asked quite often is how often should I date both my firm-wide risk assessment and my AML policies?
Yeah, so for this one, I think the HMRC guidance says it should be reviewed at least annually. And I think that even if nothing has changed, you should, as part of the good record keeping process we've talked about, you should still make a note that it's been reviewed at that point in time. And in our experience, HMRC likes to see both, reviews and records of updates if that's required. I might then ask you some questions, Colette. So how do you do meta risk assessments for repeat clients?
Yeah, so there's a couple of ways of doing this, and for most estate agents, you're probably not going to be in the position of having masses of repeat clients, so it's probably not going to come up. But you've got two ways of doing it. One is to have a standard client and matter risk assessment form that you just repeat every time you get a new instruction from a client. Or the other way of doing it, which can work equally as well, is to separate out your client risk assessment and your matter risk assessment. So you've got a single document that goes into the risk posed by your client. And then for each instruction, you do a separate matter risk assessment that goes into the details of, the property that they're seeking to sell, assuming you're acting for them as a vendor. Either can work well. The important thing to note is that if HMRC come out and do an audit, you need to be able to, for each instruction, produce a good risk assessment. But those are the two practical ways that you might separate it out.
The next question that we have is in line with what you were talking about in terms of enhanced due diligence. So the question is, how do I know if my client is a PEP?
Yeah, so identifying PEPs can be quite challenging. And I'd also say that actually the consequences for missing this can be quite adverse. A number of the cases that we've advised on the defence side have flowed from the fact that a firm has failed to figure out that their client is a politically exposed person, and they haven't done source of wealth checks, and things have kind of gone wrong from there on in. So there are a number of different ways that you can do this. If you are a larger firm and you've got electronic due diligence, the chances are that that will include an assessment of whether your client is a politically exposed person. I think if you're not sure about that, it's a good idea to get in touch with your EDD provider, check what list they're drawing from, check how they're getting their data, and most importantly, check how frequently they're updating it, because most enhanced electronic due diligence providers will have their own lists of politically exposed persons, but these do change quite frequently. So you need to make sure that they're keeping that up to date. If you're not using electronic due diligence, a couple of other ways that you might determine whether your client is a PEP Google searches is very effective, particularly if your client is a UK individual. Oftentimes that will show up on an internet search. If your client is overseas, you might be looking at sort of more specialist checks, but I'm guessing that that's probably not as common an occurrence. And the other way of doing it in conjunction with other checks is asking your client whether they are a politically exposed person. Most people, certainly in the UK, will be familiar as to whether they fall in that category and will be able to tell you. I certainly wouldn't rely on that solely, but I think in conjunction with, a couple of other checks, that can be quite a simple and effective way of establishing whether you've got a PEP that you're dealing with.
Great. And then this next question that we have is something that goes to what you discussed at the very beginning. So you talked about SARs and tipping off, and that's quite a tricky area to navigate. So the question we've got is, I've submitted a SAR, can I continue to act?
So I think you're right. I think this is quite a challenging and detailed area, and this is probably, we could almost certainly do a webinar on any one of the topics we've discussed today, but certainly submitting suspicious activity reports is certainly worthy of its own webinar. But to broadly give you the high level answer to that, there are two different types of suspicious activity reports. There's an information only suspicious activity report and a DAML suspicious activity report, which is Defence Against Money Laundering. So you would submit an information only suspicious activity report if you are not intending to continue with the transaction, you're not seeking defence against one of the money laundering offences set out in POCA. So, concealing, converting criminal property. So this might be if someone has come in, you've had suspicions about them and you've declined to act, you might submit an information suspicious activity report just to provide that information to the National Crime Agency. If you are in the middle of a transaction, you're intending to go ahead with a transaction or an instruction, what you'll need to do will be to submit a DAML suspicious activity report, Defence Against Anti-Money Laundering, and you then need to wait to hear back from the National Crime Agency as to whether you got permission to go ahead with that transaction. So the NCA have got a couple of options. They can grant you permission to go ahead. They can tell you that you are not allowed to go ahead, in which case a further moratorium period begins, in which you can't act. They can come back to you and ask for more information. Oftentimes this happens if your original suspicious activity report hasn't been sort of detailed or simple enough for a lay reader to understand what you're seeking to go ahead with. Or they can give you permission to go ahead, and they've got 7 days to do that. If you don't hear back from them within those 7 days, you can rely on deemed consent. So the NCA has deemed that you can go ahead with the transaction. But as I said, this is a really, really complex area, and it's well worth reading the NCA guidance. They've put out quite a lot of webinars and information on this, so well worth getting into the detail of that if you are in that position. I think possibly we've got time for maybe one last question.
It's just one last question, and I think this is one about supervision. So there's been news, or people have been hearing about changes to supervision, potentially to the FCA. So is there any updates or anything to comment on in relation to that?
Yes, there's not masses of updates here. So for those of you that sort of haven't had this come across your radar, The news announced about 18 months or so ago, no, not that long ago, maybe about 6 months ago, apologies, is that supervision for lawyers, accountants, and trust and company service providers will be moving away from their current supervisors, and the FCA will be taking over that supervision. There are no direct changes announced for estate agents and letting agents, so your supervisor will continue to be HMRC. There's also no timescale that's been announced for when the lawyers, accountants, trust and company service providers will move to the FCA. Smart money is perhaps 2028, so we've got a little while yet. So no direct impact for you. I guess the one thing to note is that that there has been some criticism that HMRC have been sort of perceived to be a bit under-resourced in their AML supervision. So they will be having huge swathes of their supervised population moving to a different supervisor. Which means that might mean that they've got a bit more time and a bit more resource to focus on the businesses that they still supervise, i.e. you. So I think now is a good time to sort of get your house in order before they begin any enhanced programme of AML supervision. But we said we would wrap up in about 45 minutes, so that's about all we've got time for. So if we just move on to our final slide, I will firstly thank Ian for joining me today, very much appreciated. Thank you for tuning in over your lunch hour, really appreciate your time. If you've got any more questions, you know where to find us. Contact details are on screen. We can provide advice, audit, advice around defending investigations or enforcement action, advice around policies, or if you just want to chat about anything money laundering related, get in touch. And then finally, as I said, this was a very high level overview in which we sought to cover the entirety of the money laundering regulations. Any one of these slides could have been the topic of its own webinar. So if there are particular topics that you'd like us to go into more details with, please do get in touch. But that's all for now. Thank you so much for joining us and enjoy the rest of your day.